Everyone. Today we're going to be talking about market risk in retirement. And the one thing I want you to take away from this video is how you handle market risk now will fail you in retirement. Today we're going to dive into market risk in retirement. So let's look at basically a few concepts. So starting at, I think most people are aware today that the market has periods of growth and periods of decline. So looking back at this chart, going back to 1996, we see definitely a few areas of peaks where there's a lot of market growth, but then there's definitely some market pullbacks. So in 2001, it pulled back almost 50%, 2008, 57%. During COVID, it turned down 34%. So a lot of these actions will occur pretty frequently. One thing that we also need to recognize is that not everyone retires January 1st every year. So we're always looking at everything from a calendar year standpoint. And even in good years, because typically the market is up about 75% of the time or so, roughly. But we may notice that even within a good year, we may see a market drop. So the average intra-year decline is actually about 14%. So that means even within a given year, the market may drop 14% from its highs. So we need to be aware that there's actually a good amount of market fluctuations. Now, when you're just getting started and you're accumulating assets, one of the biggest things that you have on your side is time. And as we see from this chart, the market is pretty volatile from a 1-year standpoint, but the further out you go, you'll notice that market returns are actually pretty consistent. So this green bar is basically looking at the S&P 500, and the gray bar is really looking at a mix of stocks and bonds. It's a 50-50 mix. So the general advice when you're investing and accumulating assets is don't panic. You have time, and the market will eventually rebound. The challenge is when you're a retiree, you're always taking money out of your accounts, and you have a finite amount. You're not adding to it. So you're actually really living each year in this space. And even a 50-50 portfolio, a mix of stocks and bonds, has a pretty wild range of swings. So in a given year, you could be up 33% or you can be down 15%. And if you have assets in retirement and that's all you have, losing 15% of your account balance can be pretty scary. And one thing to really consider is how often these market drops happen. So a 5% drop roughly happens about 3 times per year, and it lasts for about 46 days. A 10% drop hits about once per year and lasts about 117 days till basically recovers. A 15% drop happens every 3.5 years, and a 20% or more drop happens about every 6 years. And it takes a little over a year to recover. So what's a retiree to do? So one of the things we have to look at is, okay, how long is it going to take to break even, or what would it take to break even? So we're looking initially at a 10% drop. Let's say at $100, your account value drops to 90. A lot of people assume that, hey, I just need 10% and I'll be back to even, but you actually need to be back 11% to get back to even. So using the same $100, you drop to 90, you get 10% of 90, you're only at 99. So the further these drops go, the more you have to return to make up for it. So even a 15% drop, now you need to earn 17%. A 20% drop means you have to earn 25%. And a 25% drop in value means you have to earn 34% just to get back to where you were. So if you have drops in, basically this range or more, you need a pretty good rate of return to get back to even. I mean, typically over the last 50 or so years, the market's averaged about 10% average rate of return. So even getting the average rate of return will mean you'll fall short, if market drops of 15% or more. The other challenge that retirees have is you're not only staying stagnant with your account balance because you can't add to it, you're also taking money out. So the typical traditional safe withdrawal rate is 4%. So we added 4% to all of these drops. See, a 10% drop now becomes a 14% drop. A 15 becomes a 19, 20 becomes 24, 25 becomes 29. Now let's add that and look at how do we get back to even. So basically a market drop of 10% means you have to earn 16% to break even. A 19% drop means you have to earn 25 or 23.5%, 31.5%, and then a 41% rate of return just to break even. How long do you think would it take you to earn 41% just to get back to where you were? And this isn't even including that each year now you're still taking 4% from your account balance. So you could actually dig yourself a pretty decent hole. So what does that mean for your retirement portfolio? And there's two things in factor here. There's the math piece of it, but then there's also the behavior piece of it. So the math piece of it says, hey, look, let's maybe de-risk a little bit. Let's make sure our portfolio's as safe as it can be. But even looking at the other slide with a 50 portfolio, 50% stock and 50% bond, we've noticed that in a given year it can drop 15%. That's a pretty significant drop. Throw on the 4% there, we're back at a 19% loss in 1 year. The other part of it is the emotional aspect of it. So let's say you start with $1 million at retirement. It's kind of this random benchmark that most people say. You're taking out 4% per year, which means you're taking distributions each year of $40,000. Now, the other thing to look at is that each year this is going to basically increase by the inflation rate. So if inflation is 2%, you're adding 2% each year to that 40,000. If it's 10%, you're adding 10% to that $40,000 per year. So let's say we did have a market drop and it did drop even just 10%. So now we're down to 900,000 in our account balance, but we still need to take this $40,000 out. So now we're down to 860,000 in our retirement account. So basically, at what point are you getting concerned about your account? If you lost $140,000 basically in 1 year, and that's all you started with your retirement plan, what would you do? A common refrain for people says, hey, look, this is all I have. I'm worried about the market. I don't know when it's going to come back. So I'm just going to move my money to cash. And a lot of people will tend to do that. They'll just say, hey, I'm going to pull back. This is all I have. I want to make sure it's safe. I want to make sure it's not going anywhere. But the challenge is because of this inflation number, we need to keep pulling out 40,000 plus inflation every single year. Okay. So a lot of people at that point, if they go to cash, will now say, now I can't keep up with inflation. So now you're fighting another battle. So that's where we run into a lot of trouble. And just staying as is and staying ultra aggressive can mean you're subjecting yourself to a lot more market drops. So if we, let's say, went from a 50-50 to a 80% stock portfolio, now we're subjecting ourselves to more and more market risk, which can impact us later on in retirement. So a 15% drop may next time be a 20% drop. So we're creating this other vicious cycle. So it's really challenging for a retiree to really look at how do I manage this market risk? And the best thing you do is manage it going into it. So stay tuned. I'm going to have another video next week. We're going to talk about what you can do to combat market risk in retirement. So I'm Derek Mazzarella, CFP with Gateway Financial Partners. Hopefully you like this video. Please feel free to like and subscribe because this way other people get to know about it. Talk to you soon.